The VeriPlan Overview video is divided into two parts. This is part 2 of 2 parts. It focuses on VeriPlan's output graphics and data. The first video focuses on VeriPlan's user input functionality. Both parts of this overview video have the same 90-second introduction, and after this short introduction, the two parts are different. This is the VeriPlan Graphics Overview video. VeriPlan is a comprehensive lifetime do-it-yourself financial planning application. It enables sophisticated, low-cost family financial planning. With VeriPlan, you can build your own lifetime projections for financial planning decisions. This is a functional overview of VeriPlan through the live development of a lifetime financial projection plan. I am the VeriPlan developer. My name is Larry Russell. These are the universities that I went to and the degrees that I hold. I'm President and Managing Director of Lawrence Russell & Company. If you want to know more about me, this is my LinkedIn page. If you're interested in VeriPlan, please go to the VeriPlan website. Just go to www.theskilledinvestor.com/VeriPlan/. At the VeriPlan website, you will also find multiple pull-down menus with helpful personal financial planning articles. Before we move on to VeriPlan, understand VeriPlan's platform requirements. It will run on any Windows PC or Macintosh with Microsoft Excel. It's a fully contained Microsoft Excel workbook application. It has been functionally stable and robust since the year 2006. I have made annual enhancements and updates up to the present. Now let's continue on to VeriPlan. This blue-tabbed graphics and data spreadsheet provides an overview of VeriPlan's output graphics and data. VeriPlan's roughly 24 blue-tabbed graphics are listed here with these bold titles. Further down on this worksheet, each of these graphics has a section that explains them in detail. These graphics are the visual lifetime projection output that VeriPlan automatically generates for your analysis. When you make any changes to VeriPlan on the yellow tabbed input worksheets, VeriPlan will instantly update all affected graphics. In addition, note that there are two green tabs to the far right titled Graphics Data. The Graphics Data worksheets list all of the numerical information that VeriPlan uses to draw its graphics. When you wish to make precise numerical comparisons between different models, consult the graphics data. The data on the two graphics data worksheets are the same. If you are 40 or over, just use the 40-100 graphics data worksheet. Next, we will click and go on to view the blue tab graphics one at a time. The first graphic is the family income graphic. It includes earned income, pensions, annuity payments, Social Security, rental income, etc. It excludes returns on financial assets and investment asset withdrawals. Since this is the first graphic we are reviewing, these are a few comments about the standard layout of VeriPlan's output graphics. The horizontal axis is age. Data begins with the initial age of user number 1 and continues through age 100. The vertical axis is dollars on the left-hand side for most slides. VeriPlan's graphics use real constant purchasing power dollars with inflation removed. Some other slides will graph percentages on the vertical axis. Microsoft will automatically scale the numbers on the vertical axis as appropriate for the data being graphed. All VeriPlan graphics have a legend at the bottom labeling the data being displayed. Data series have different colors so that you can distinguish them on the screen. Data series also have patterns or lines so that you can distinguish them even if you print in black and white. For this income graphic, the light blue area with horizontal bars is the wage and salary income of earner number 1. The darker blue area with vertical bars is the self-employment income of earner number 2. Note that earner number 2 works for 2 years more than earner number 1 because there is a 2-year age difference. Social Security retirement income is the green area with diagonal bars. Both earners accept Social Security at age 70 because they did not adjust the defaults. Through further analysis, either might decide to use a different initial age for Social Security. Next, we will click and view the blue-tabbed expenses graphic. The family expenses graphic shows their $75,000 in ordinary expenses. These ordinary expenses exclude tax payments, debt payments, and asset expenses, which VeriPlan automatically projects elsewhere. Note that expenses are graphed as negative numbers since they represent cash outflows. Also note the other category in the legend. If this couple had chosen to make any year-by-year expense adjustments on the yellow-tabbed expenses input worksheet, then these other expenses would have been graphed as this other major expense category. Next, we will click and go on to the debt payments worksheet. This family's debt payments graphic shows the annual payments for their $50,000 educational loan. Again, these annual loan payments are graphed as negative numbers since they represent cash outflows. Note that the debt payments appear to decline over a couple of years even though they are making a fixed payment of $1,000 per month. This is because VeriPlan projections use real constant purchasing power dollars. The same nominal dollar debt payments made in future years are in fact made with dollars that are depreciated by inflation. Next, we will click and view the blue-tabbed Personal Taxes worksheet. VeriPlan automatically projects lifetime tax payments in 8 separate categories. This couple's projection is subject to 5 of these 8 tax categories. During their working years, this couple pays federal income taxes, which are in the maroon area. Their state income taxes are in the light blue hatched area. Their Social Security employment taxes are in the light blue area. And their Medicare tax payments are in the dark maroon area with the small dots. Note that their federal and state tax payments decline in the first few years of their plan. The decline after the first year is due to the fact that earner number 1 has not been contributing to the 401k plan before, but earner number 1 now has decided to start to make contributions, and this will significantly reduce the family's federal and state income tax payments. In addition, VeriPlan has made this couple aware that they each have a right to make deductible IRA contributions, and they have decided to start contributing to IRAs in addition to the 401k contributions of earner number 1. You will also note that federal and state income tax payments decline further after the first several years in this area here. The reason is that they pay down and pay off their educational debt. As debt payments decline in real dollar terms and their incomes rise in step with inflation, they have more free cash flow from earned income to make contributions, which reduces their federal and state taxes even more. After that, their federal and state income taxes will level off until they retire. Note that without 401k and IRA contributions, they would have paid about $17,800 a year annually in federal and state income taxes until they retired. With the deductible contributions, they will instead pay about $10,900 annually in federal and state income taxes through retirement. Thus, their federal and state income tax payment savings are about $6,900 yearly for about 35 years. That means they pay about 240,000 fewer federal and state income tax dollars prior to retirement. Plus, they have decades of compounded investment growth on those tax-deferred assets held in their retirement accounts. The other side of the coin with tax-deductible retirement account contributions is the obligation to make taxable required minimum distributions now starting at age 72. Taxes associated with required minimum distributions are represented in the dark blue area over here. While required minimum distribution taxes accelerate with advanced age, you should note that the vast majority of people will come out ahead financially by contributing to retirement accounts and reducing taxes earlier in life, even if they're subject to required minimum distributions in retirement and are lucky enough to live a long life. Next, we will click and view the blue-tabbed Rentals and Property graphic. This is the rental real estate graphic. This young couple does not own any rental real estate. If they did, this rental real estate line graph would show positive and negative cash flow, revenues, expenses, and debts, and taxable incomes net of depreciation that would flow onto their personal income tax return. Next, we will click and view the blue-tabbed cash flow graphic. This cash flows graphic shows the combined effects of the income graphic, expenses graphic, debt payments graphic, personal taxes, and rental and property graphics. During this couple's working years, they must have generally positive cash flow so that they can save and invest over the long term in both taxable and tax-advantaged retirement accounts. If they do so, they will have sufficient assets in retirement to support the negative cash flow that they would experience. You will note that their cash flow is noticeably more negative during the transitional years between retirement in their mid-60s and the beginning of Social Security payments at age 70. In their early 70s, their negative cash flow reaches a low point and then increases gradually due to taxes associated with increasing required minimum distributions. Next, we will click and view the blue-tabbed savings rate graphic. This graphic shows the annual percentage savings rate of the family during their working years, excluding any investment asset returns. You should note that savings rates over 10% sustained for 3 or 4 decades combined with normal retirement age tend to support a comfortable retirement while building long-term wealth. Next, we will click and view the blue-tabbed human capital graphic. Without inheritance or long-shot lottery winnings, the only asset anyone has at the outset of adulthood is their human capital or their ability to earn a living and save. To illustrate this reality, VeriPlan projects expected lifetime earnings as human capital. As the years pass, there is less time to earn and thus human capital declines. This darker green wedge is gross expected human capital at any projection age. Gross human capital is expected lifetime earnings that are consumed along the way and used to pay ongoing expenses, debts, and taxes. This lighter wedge with diagonal green bars is the net expected human capital at any projection age. Net human capital is also expected lifetime savings after expenses, debt, and tax payments. If any financial projection plan in VeriPlan does not show a noticeable wedge of net human capital or savings, then the lifetime financial plan will fail. Of course, without a substantial inheritance or that lottery long shot. Next, we will click and view the blue-tabbed Asset Allocations worksheet. The financial asset allocation graphic shows the year-by-year lifetime asset allocation percentages for cash, bond, and stock financial assets. This couple already had a 10% cash, 30% bonds, and 60% stocks portfolio, and they chose to continue with that asset allocation model throughout their projection. Cash is the yellow area at the bottom with the brick pattern. The light blue area in the middle is for bonds, and the darker blue area at the top is for stocks. Note that VeriPlan will automatically rebalance your projected portfolio to your chosen asset allocation model at the end of every year. Next, we will click and view the blue-tabbed Total Assets graphic. VeriPlan's Total Assets graphic projects the cumulative lifetime value of all your cash, bond, and stock assets and all types of accounts. These are the assets that you accumulate over time, net of income, expenses, debts, and taxes. For this couple, their projected savings or net human capital is graphed here as a reminder. But it is not a tangible asset until earned, saved, and invested in cash, bonds, stocks, or property. Just like financial asset classes are represented on the asset allocation graphic, cash is the yellow area with the brick pattern at the bottom. Bonds are the lighter blue area with dots in the middle, and stocks are the darker area in solid blue. Note that if you owned a home or rental real estate or some other property, it would show as a different wedge on this graphic. The red wedge that widens at the top represents assets lost to excessive investment costs. While it might look like at age 100 they have accumulated over $8 million, the red wedge represents 7 decades of asset losses due to excessive investment costs. Instead, if they are lucky enough to live to age 100, they would have only about $4 million in assets. Not bad, but still much less than they might have accumulated with a very low-cost investment strategy. The financial industry will glibly tell you that investment costs are, quote, just a few %. The problem is that investment fees deceptively deplete the financial asset base that is already yours. Investment costs are not assessed against only your annual asset returns, if and only if the financial industry were to add value in terms of superior returns, which the industry provably does not do, especially over the long run. This couple's portfolio is not much different than the average investor's portfolio, which over the last 90-plus years has returned about 5% annually in compounded real dollars with inflation removed. Therefore, an unproductive 1% annual fee against the financial assets that you already own is really a 20% deadweight loss on your portfolio's 5% average returns. And these lost returns will compound year after year across your lifetime in someone else's account. Assets lost to excessive investment costs tend to accelerate after you retire. While you may need to draw down your retained assets to cover negative cash flow in retirement, assets lost to excessive investment costs will accumulate without this drag. Next, we will click and view the blue-tabbed Asset Taxability graphic. This is the Asset Taxability graphic. VeriPlan distinguishes between assets that you hold in taxable accounts, in traditional retirement accounts, and in Roth retirement accounts. The graphic shows the distribution of this couple's financial assets by account type through age 100. Taxable assets are in the green area. Traditional retirement account assets, including their 401ks and IRAs, are in the blue area with diagonal bars. Throughout their working years, they build up their traditional retirement account assets. The left vertical axis is the black line graph of their required minimum distributions. After required minimum distributions begin, you will see that traditional account assets decline while their taxable account assets increase. Even though this couple has some negative cash flow in retirement, they do not need most of their required minimum distributions to close that gap. Therefore, after paying income taxes on required minimum distributions, VeriPlan automatically reinvests most of their net required minimum distributions into taxable accounts. Next, we will click and view the blue-tabbed Asset Flows graphic. This is the Asset Flows graphic, which combines the overall effects of your projected operating cash flows with your projected net cash, bond, and stock returns. The blue line with short dashes is the operating cash flow, which is equivalent to the cash flow area graphic that you saw before. The green line with longer dashes is the annual return on cash, bond, and stock financial assets. And the black solid line is the overall change in net assets, which combines operating cash flow with net investment returns. For this couple, their total assets are projected to increase in every year except 1 year when their cash flow drawdown is the greatest just before their Social Security retirement payments begin. Next, we will click and view the blue tab Debt Owed graphic. This graphic indicates the debt principal owed in several categories as debts are paid off. These categories include previous consumption debt, such as credit card balances related to past overspending. Another category is personal investment debt, or debt that is undertaken to improve one's financial prospects, such as sensibly incurred educational debt. An example is the remaining $50,000 educational loan debt that this couple incurred to increase their earnings ability. If they had such debts, this graphic would also show separate areas for residential mortgage debt, rental real estate debt, and other properties debt. Note that if cash, bond, and stock financial assets are projected to run out at any time during the projection, then VeriPlan will automatically accumulate unfunded debt for this unfortunate situation. Next, we will click and view the blue-tabbed Retirement Income graphic. This retirement income graphic shows income sources for years after earner number 1 has retired. Income for this couple includes 2 more years of earner number 2's self-employment income. The green area with diagonal black lines is their Social Security retirement income. If they had any pension or annuity income, that would be graphed. If they had any real estate or property income, it would be separately graphed as well. Note that the right-hand vertical axis indicates the pre-tax amount of their increasing required minimum distributions. Some people think required minimum distributions are income, but RMDs are really just forced traditional retirement account distributions that are taxable as ordinary income. RMDs can cover negative cash flow, but any RMDs left over after expenses and taxes are just reinvested financial assets that are shifted to taxable accounts. Next, we will click and view the blue-tabbed Retirement Shortfalls graphic. This retirement cash flow shortfalls graphic takes a closer look at the projected coverage of negative cash flow by required minimum distributions in years after earner number 1 has retired. First, the solid red line is any projected operating cash flow shortfall during retirement. This equals the cash flow graphic for years after earner number 1 is retired. The black dashed line that has short dashes is the pre-tax traditional required minimum distributions that we have seen on other graphics. The blue line with medium length dashes is the cash needed to pay income taxes associated with these required minimum distributions. And then the bolder black line with long dashes is the net after-tax required minimum distributions. And therefore this line, this long dash line, is this short dash line with the taxes subtracted from it to get this as the net. And then to summarize all of this projection data, this solid green line is the difference between the required minimum distributions and the operating cash flow here. In years when the green line is above $0, this means that RMDs are projected to cover all taxes and negative cash flow, with some assets left over for reinvestment in taxable accounts. However, if the green line is at the $0 line, then this means that negative cash flow exceeds after-tax RMDs. In that situation, additional assets would need to be liquidated to cover the portion of the negative cash flow that RMDs did not fund. Next, we will click and view the blue tabbed withdrawals graphic. The withdrawals graphic is presented as the percentage of total cash, bond, and stock financial assets that would need to be withdrawn in any projection year to cover negative cash flow in retirement. You may have heard of financial advisor rules of thumb, such as the safe 4% withdrawal rate. Such rules are based upon historical studies of the withdrawal rates that people's portfolios in the past could have sustained successfully over several decades. Given the uncertainty of the future, it is advisable to monitor percentage withdrawal rates in retirement. This couple's withdrawals are projected to be well under a 4% withdrawal rate, and this is a significant reason why their assets are projected to continue to grow in retirement. This withdrawals graphic also follows up on the previous retirement shortfalls graphic. This graphic indicates how much of overall percentage withdrawals are funded by required minimum distributions. The RMD portion is indicated by the overlay with the black diagonal lines. If RMDs would have covered only a portion of the percentage withdrawal needed in any given projection year, then some of the total withdrawal percentage area would be red without any of the black overlay diagonal lines. Next, we will click and view the blue tab transactions graphic. We will skip the value of time graphic for this video because it is conceptually complex. However, in a nutshell, the value of time graphic is designed to help older workaholics understand when it is time to stop working because their assets are earning much more than they are, and the sands of time are running short. This transactions graphic helps you to understand the required movement of cash in and out of taxable accounts and tax-advantaged retirement accounts. Understanding transaction flows can be helpful when you evaluate your projection in detail. The solid black line is the net financial asset transactions, which equals the blue tabbed cash flows graphic. For this transactions graphic, the solid black line is the combination of the dashed green line and the dashed blue line. The dashed green line represents transactions in and out of taxable accounts, and the dashed blue line represents transactions in and out of tax-advantaged retirement accounts. During this couple's working years, almost all of their net positive cash flow is contributed to their 401k and IRAs to reduce their income taxes and to save for retirement. During the transition years in their late 60s after retirement, taxable account withdrawals would fund cash flow shortfalls. Once required minimum distributions begin, assets are withdrawn from retirement accounts. The required minimum distributions fund tax payments and cover the cash flow shortfall. The net that remains is automatically deposited into taxable accounts, which grow in value. Next, we will click and view the blue tabbed safety margin graphic. Some people are understandably concerned about how their finances might enable them to survive a financial catastrophe in the future. This safety margin graphic projects how long your cash and bonds would cover your necessary living expenses going forward at any point in the future if all of your expected income sources disappeared and your stocks became valueless. The safety margin graphic admittedly represents a very pessimistic scenario. Note for this couple that by their early 50s, their cash and bonds would fund about 5 years of necessary expenses going forward. In effect, by their early 50s, this couple is projected to be able to pay their necessary expenses for 5 years while waiting for some income sources to be restored and/or for the value of their stock assets to recover. Note that you can make adjustments to the various parameters that affect this graphic on the yellow tabbed Risk and Returns Input worksheet. Now we will move on to the life expectancy graphic. Note that at this point we will skip 3 of VeriPlan's graphics associated with investment costs: the cost efficiency percentage graphic, the cost efficiency dollar graphic, and the sales load graphic. These 3 investment cost related graphics would only be informative if a user had entered a more complex current portfolio on the yellow tabbed financial assets worksheet, and if that user had researched and entered investment cost details about their specific cash, bond, and stock holdings. Now we will click and view the blue tabbed life expectancy graphic. This life expectancy graphic presents U.S. life expectancy data from the Social Security Administration. The solid black line across the top is the expected average total lifespan for females, and the solid red line across the top is the expected total lifespan for males. You will notice that both the solid black and red lines rise gradually with age. These lines rise because they represent the total life expectancy of a person who has already been fortunate enough to have lived to the age indicated on the horizontal axis. In effect, the expected average lifetime increases for those who simply stay alive. The dashed black line declining in the lower portion of this graphic is the expected average remaining lifespan for females, and the dashed red line declining in the lower half of this graphic is the expected average remaining lifespan for males. Again, this remaining life expectancy data is related to the age indicated on the horizontal axis. VeriPlan presents average life expectancy data for your information only. These life expectancy data do not affect VeriPlan projections. Some lifetime financial planning software applications require you to make mortality assumptions, such as I will die at age 87. And that is as long as finances will be projected. But what happens if you live longer? Could you afford to live longer? VeriPlan avoids mortality assumptions by automatically providing fully integrated cash flow projections through age 100 for a single person or a married couple. Given this average life expectancy information on this graphic, it is highly unlikely that a single person will live beyond age 100, and it is even more unlikely that both members of a couple will live to age 100 or beyond. If they die before age 100, their projected assets would simply estimate the size of their estate at the time of death. Even if you live to beyond age 100, these remaining life expectancy numbers will give you a sense of whether your projected assets at age 100 in VeriPlan might fund the few more years of life indicated on this graphic. We will now click and view the blue tabbed historical returns graphic. This graphic indicates annual cash, bond, and stock financial asset rates of return for the last 90 years. These annual percentage returns are used to calculate the compounded asset class returns that VeriPlan uses to generate investment asset projections. Of course, you can modify these compounded rates of return on the yellow-tabbed Risk and Returns worksheet. On this graphic, annual CPI inflation rates are indicated by the dashed red line. The 90-year compounded annual U.S. CPI inflation rate has been 2.98% or very close to 3%. VeriPlan uses real constant purchasing power dollars with inflation removed to generate projections. Therefore, the annual cash, bond, and stock returns on this graph have already been adjusted for the CPI inflation rate. The solid green line is the annual return on cash based on the historical 3-month U.S. Treasury bill return. Notice that this green annual cash line tends to stay very close to the horizontal 0% axis. The 90-year compounded annual 3-month U.S. Treasury bill return has been 0.44% with inflation removed. The solid black line here is the annual return on bonds based on the historical 10-year U.S. Treasury bond return. The 90-year compounded annual 10-year U.S. Treasury bond return has been 2.6% with inflation removed. The solid blue line is the annual return on stocks based on the historical Standard & Poor's stock index return. The 90-year compounded annual S&P stock index return has been 6.5% with inflation removed. Because these asset class returns fluctuate significantly from year to year, they can be difficult to interpret visually. Therefore, VeriPlan provides an additional graphic with the same data presented as 5-year rolling returns. We will now click and view the blue-tabbed rolling returns graphic. This graphic uses the same 90-year cash, bond, and stock financial asset class rates of return used by the previous historical returns graphic. On this graphic, cash, bond, and stock returns and the CPI index are presented as compounded 5-year rolling calculations. These rolling returns take the prior 5 years of data to calculate the compounded rolling return. The first 5-year rolling return uses the first 5 years of data. Then, to calculate the next rolling return sequentially, the oldest or 6th year in the past is dropped off, and the most recent year is added to do the calculation. This process repeats until the most recent year of data is included. These 5-year rolling returns reduce the noisiness of the data to reveal information that matches historical memory. In the first years of the Great Depression, following the crash in 1929, rates of return on cash and bonds skyrocketed, while the effects of the stock market crash are obscured by the 5-year rolling calculation. During the mid-1930s, the stock market recovered, but not completely. With the advent of World War II, cash and bond rates of return declined significantly. The 1950s and 1960s experienced a dramatic stock market expansion. Increasing inflation in the 1970s hammered cash, bonds, and stocks alike. Beginning in the 1980s, real dollar cash returns after inflation languished, and they have languished since then. The green line here. Bonds began what has been termed a 30-year bull market, aided by the tailwind of generally declining interest rates. Stocks experienced another significant expansion in the 1980s and 1990s. However, compared to the prior historical returns graphic, with these 5-year rolling returns calculations, it becomes more difficult to detect the dot-com crash of the 2000s or the credit crunch of 2008 and the subsequent Great Recession. 5-year rolling return numbers can obscure dramatic financial events, while at the same time they help draw our attention to the longer term, wherein cash, bonds, and stocks have demonstrated significantly different returns. Now we will click and view the green tabbed Graphics Data Worksheet. With the far right green-colored tabs, VeriPlan provides a consolidated spreadsheet with all of the data used to draw VeriPlan's blue-tabbed graphics. If you wish to make numerical comparisons between your different VeriPlan projection models, this is where you will find the number series for all of VeriPlan's output graphics. You will note that there are 2 data worksheets. These 2 data worksheets are the same with one exception. The Graphics Data 40 to 100 worksheet only presents data for ages 40 to 100. If you are 40 years or older, you should use this 40 to 100 Graphics Data worksheet. Both of these graphics data spreadsheets are pre-formatted for printing. Because the 40 to 100 spreadsheet removes ages 18 to 39, when printed, the output is larger, which tends to be easier on aging eyes. This graphics data spreadsheet is scrollable both vertically and horizontally. Age is the vertical axis. You will notice that earned income data begins at age 32 with the initial age of earner number 1. If you scroll down to the bottom and click any of these blue links entitled Move Up to the First Year, you will automatically jump up to the top of the page, and the top will now align with the age of earner number 1. Looking across the top, you will notice that the first headers you see are for the income graphic, which is also the first output graphic tab that you encounter when moving from left to right. Also note that a narrow gray bar vertically separates the data columns of one graphic slide from another. Without further commentary, I will now use Microsoft Excel's horizontal scrolling controls to the lower right to scroll across this worksheet so that you can glance at the headers. And now back we go. This is the last of the user-accessible worksheet tabs, so we have come to the end of our VeriPlan video tour. Thank you for allowing me to present these VeriPlan features to you. If you're interested in using VeriPlan, please go to this webpage, www.theskilledinvestor.com/veriplan/. Thank you very much.